Hello viewers, my name is Arun Sundaresan. I head product management at Nippon India Mutual Fund. We are happy to introduce to you a new fund offering called Nippon India Multi-Asset Fund. I wanted to speak to you about this fund, explain to you about the features and why we think this may be an interesting proposition for you to consider investments into. I would like to show you a small presentation where we'll show you very strong data points, give you examples, and take you through the details of the fund and explain to you as to where it fits into your portfolio. Follow me to share the screen, please. So as many of you would know, it's a fact that different asset classes tend to perform at various points in time. The data that you're seeing here is the calendar year return, every year return of different asset class over the last 10 years. As you can observe here, in fact, in the last 10 years, non-intuitively, gold has been the best asset class in 5 out of the last 10 years. Equity has been the best asset class in only 3 of them. Debt has been the best asset class in 2 out of the last 10 years. And as you can notice in this chart, asset class performance have been all over the place. What has been the best performing asset class in 1 year, probably the next year it would be the worst, and vice versa. And these changes happen quite frequently. Not only do the different asset classes perform at various points in time, the extent of performance, outperformance, and underperformance can also be significant. For example, the last 2 years is a good case in point. Gold has gone up by a whopping 70%. Debt returns have been nearly 20-25%, whereas equity return during the last 2 years have been negative. Now, if you thought this was an exception, it happens very, very often and in quick time. For example, 2017, 2014, 2014, for example, equity gave something like 35-40% return, whereas gold return was negative. In a year like 2013, both equity and gold gave subdued or negative return, whereas debt was the better performing asset class. So very clearly, different asset class, not only they perform at various points in time, the extent of outperformance, underperformance can be as high as 50%, 60, 70%, and these can happen in a matter of 1 year and 2 years. Therefore, it may be important for you to be present in those asset class as well as and when they perform so that you capture returns in those asset classes and your overall portfolio returns get benefited and not be overexposed or be invested only into one particular asset class. Now, so far, we spoke about equity, gold. We saw some data, and the data is very, very compelling. Now, we also wanted to present to you international equities, which is again a unique category. So here we are presenting to you as a case in point, US equities, just to illustrate to you, S&P 500, which is a US index. Compare that with Indian index. In the last 10 years, it has given 35% higher returns. Not only that, when you invest into international equities, you also get benefited by the underlying currency possibly appreciating, in this case, US dollar. In the last 10 years, the US dollar has appreciated by more than 50%. So in terms of dollar returns, the total outperformance has been nearly about 85%. Not only that, much like the previous chart where you saw, it's not just the total outperformance, but at various points in time, the extent of outperformance tends to vary as much as 25%, 40, 45% over several times in the past. So therefore, again, you need to be invested into these kind of asset classes, be it gold, be it international equity, or in multiple asset classes, and not just be present in one particular asset class. In which case, for some reason, if that asset class does not perform, the overall returns can suffer. Therefore, we are introducing this new offering to you, Nippon India Multi-Asset Fund, which will make meaningful allocations to multiple assets, and therefore your portfolio may be suited for all market conditions. And I'm going to explain to you why we are saying that. So in this particular fund, we will make a very disciplined, static, constant allocation to multiple asset class in the following manner. That is, domestic equity, we will invest 50%. Overseas equities, we will invest 20%. commodities, which will include minimum 10% gold, overall commodities will be 15%, debt will be 15%. So as you can notice here, the design of the product has been done keeping in mind that end of the day, India is one of the fastest growing economy. Therefore, equity as an asset class would tend to perform very well in the longer period of time. Having said that, that does not mean that all our investment should be only into that particular asset class or be extremely tilted towards that asset class. As you saw the merit, there is also very good case for you to invest not only in equity, but also to keep your investments into multiple other asset class. Therefore, keeping 50% in domestic equity, the remaining 50% meaningfully investing into other asset class in the proportion mentioned in this particular slide. So as you can notice here, you have overseas equity 20%, commodities 15%. Both these asset class are dollar denominated asset classes, meaning even currency could come into play, which to explain to you, for example, you invest into gold and 1 year gold return is flat. Your Indian currency depreciates by 5%, you will still end up making 5% return in the gold investment. So therefore, for 35% of the portfolio, even currency could be at play. Therefore, you're in technical terms investing into 5 different asset class, which is 50% domestic equity, overseas equity, commodity, debt, and for the 35% of the portfolio, currency. So as you can appreciate here, all these asset classes are quite different, which is what we are presenting as correlation. A correlation of one would mean that both the asset class tend to move exactly in the same direction and tend to give you exactly similar returns. For example, one asset class is given 10%, the other asset class also gives you 10%. A low correlation or a negative correlation would mean that they tend to behave differently, which is what gives you the benefit of diversification. When one particular asset class goes through a bad patch, maybe the returns are a little subdued, the other asset class could perform differently. Therefore, at a portfolio level, overall, there could be a balancing out of return. Therefore, your return profile and therefore the risk, all of that could be fairly, palatable. So that is what is the benefit of portfolio diversification. So we did back testing. What we did is we took data on a 10-year basis, on a daily basis. If you had invested as per this 50, 20, 15, and 15 kind of an exposure, what kind of returns you would have got and compared that with individual assets. So what we got is on an average, the 3-year return, the average 3-year, we call it rolling return for the portfolio turned out to be 12%, which is what is presented in column 1. Incidentally, that return is similar to domestic equity. Domestic equity also during this period gave 12%. But what is more important is you will appreciate investment is not just about getting return. You should also get that fairly consistently with the risk mitigated at various points in time. Therefore, if you look at the risk metrics, for example, we call it drawdown, the worst return in equity over a 3-year period has been minus 6.4% CAGR, which is minus 20% in absolute terms. And nearly 4% of the times, that's 3.8%, 60 occasions in the last 10 years, which is not much, but still 60 occasions in the last 10 years, returns have been negative. On the other hand, if you look at the portfolio, except 3 occasions that happened in March of this year, practically 100% of the time, there was no negative return. The portfolio gave positive return almost 100% of the time. If you look at the return profile, nearly 90% of the time, the portfolio gave above 8%. Nearly 80% of the time, the returns have been above 10%. So you compare that with individual assets, whether it is domestic equity, gold, or any particular asset class, the return profile seems to be as a combination quite interesting. At the same time, the risk matrix as measured by the drawdown, which we pointed out, the negative return instances, as well as volatility measures like standard deviation, they tend to be much lower than individual assets. So that's the beauty of diversification. If you put together different assets which perform at various points in time, collectively as a portfolio, you could end up getting reasonable returns while other risk metrics are, will be in your favor. We call the superior risk-adjusted return. A lot of times, this term tends to be theoretical in nature. Investors may not appreciate it. But today, if you look at the bottom chart below, if you had invested only into one asset class, let's say equity, the 1 year return is flat, is about 1.5-2% kind of numbers, whereas a portfolio like this could have given you something like 11%, and that is true of 3 years and 5 years periods as well. Now, why obviously this happens is while equity may be going through a bad patch right now, there are other components in the portfolio. In this case, international equities, gold, debt, all of these things have actually done relatively better. So therefore, as a combination, the return could have been very good. So this is what we call as not just getting return, but getting them, with acceptable risk. So that is what a proposition like this could bring to the table. So this is a kind of a technical chart it looks like, but what we're pointing out here is that the fund, because of the design, it has the potential to generate returns, to balance out returns across cycle. For example, if you look at the last 10 years, it has been a cycle where overall there has been risk aversion. People have not been very confident in investing in equities. It's been a dollar bull market where US dollar had been strong. Developed markets like US have done very well. If this kind of a scenario were to continue to play out, relatively speaking, in this portfolio, global equities will do very well. Gold, which is what has happened in the last 10 years. You saw that data earlier. That would do well because liquidity will be very high. Interest rates generally will be low. Debt would do very well. All of these, and in global equities and gold, currency also will come into play here positively. So all of these things would work in your favor. And when compared to domestic equity, which could have relatively underperformed, as a combination, your portfolio return could still be reasonably good. On the other hand, if the reverse were to happen, if the cycle were to turn and risk appetite were to come back very, very strongly, like what we had in 2003, 2004 kind of an era, there in this portfolio, relatively speaking, domestic equity should do very well. Commodities will do very well. Gold, time to time, could keep showing up in terms of return, and debt again could give you kind of stabilized returns. So broadly, that is what we think, either in the extreme long cycles like 10 years, or even in the last 1 or 3 years, if you look at how things have panned out, the way the portfolio structure, it could generate returns across cycle. So that's the proposition. So you can think of this like a good IPL team. So you have 4 foreign players, you have domestic players within that, batsmen, bowlers, wicketkeeper. So in a bad day, maybe your batsman did not fire, but that does not mean that you will lose the match. If your bowling is strong, your fielding is quite good, possibly you could still win the match. So as long as you have a good balanced team, you should be able to win most of the matches, if not all, and that may be regardless of the pitch conditions. So broadly, conceptually, that is what asset allocation works. So to quote, this is by Mr. Richard Perry. He has written a famous book on asset allocation. Asset allocation eliminates the need to predict the near-term future direction of the financial markets and eliminates the risk of being in the wrong market at the wrong time. So precisely today, when you individually look at any asset class, whether it is gold or equity or debt or even US equities international, everything you will start wondering whether it is already at a very high level. Will it take a correction? Is this the right time? So at any point in time, not just now, you will have views, there will be counter views, but more important than that, and taking individual calls on any particular asset class. Rather, if you make meaningful allocations across asset class, let that work. All these are differently correlated. So even if 1 or 2 asset class does not perform as expected, maybe the other components could come to the rescue, and overall, you could kind of have a balanced out returns over a period of time. So that's the entire proposition. So whatever data I showed you, these are all past data. It is not indicative of future returns. So I must give you a disclaimer there. But then you would have got a broad sense of what this is capable of. At least for the period of backtesting, we noticed that the return profile was equity. In fact, actually turned out to be superior than equity. And it was coming to you at much lower risk metrics, as pointed out by data pertaining to drawdown or volatility. So you're getting equity plus kind of a return profile with much lower volatility. And that is what we think could be a very, very powerful proposition that you could consider. So those are the scheme details. The NFO is closing on August 21. That's the product label. Disclaimer. Thank you very much for your time.